Hello and welcome to LSR Weekly View. Emerging market growth has accelerated to 3.9% in Q2 this year from close to 2.4% in Q3 last year. Is this the start of a sustained rebound in emerging market growth? Before we answer that, let's step back and see which countries are driving this acceleration in growth and what are the key factors driving this acceleration in growth. China has been at the forefront of the rebound in EM growth. Fiscal policy, quasi-fiscal policies, and of course, a weaker yuan have helped Chinese growth. Outside of China, it is Brazil and Russia. Bear in mind, real GDP in these economies is still contracting annually, although at a much slower pace than in the last few quarters. The more constructive stories in emerging markets, however, lie in our preferred EMs of the Philippines, Indonesia, and more importantly, India, which remains our preferred EM on both cyclically and structurally, on both a cyclical and structural basis. So what has changed? What is driving this acceleration in emerging market growth? We think emerging markets are in a sort of sweet spot right now. The strong dollar, which was one of the biggest threats for emerging markets, is showing signs of fatigue. Non-interest rate policy wars is now replacing the sort of currency wars that was so rife until recently. Policymakers have managed a well-behaved depreciation in yuan, contrary to what happened in August, something which inflicted tremendous volatility in not just in emerging markets but across the world. Energy prices have stabilized, Brexit fears have eased. The search for yield is very much rife, with the Bank of England now joining the Bank of Japan and the ECB in QE. The market is pushing back Fed rate hike expectations, and domestically, emerging markets themselves have made tremendous improvement in competitiveness and have reduced their imbalances. The most important question, however, is where do we go from here? We think caution is warranted. Chinese growth will decelerate in second half of this year unless the government further ramps up its stimulus program. Emerging markets ex-China have seen their currencies appreciate, and that means they have the competitiveness gains that they enjoyed since 2013 has sort of given way. Structural reforms have been missing in most emerging markets, and improving macro fundamentals mean that global yields will rise over the next 12 to 18 months. So in a nutshell, improved competitiveness, lower balances, and higher interest rate differentials with the US mean emerging markets are better placed to deal with higher global yields, although they are not immune to it. So for more details, read our report and see you next week. Thank you.